Hello, everyone. Welcome to the stock specific class here for Thursday, January the 26th. As always, if you have any questions during the week or any questions I don't get to here in the live class, make sure you send those to jerry@traderspro.com. Again, just a real quick check if on the audio, if anyone hears any clicking or a noise in the background that's annoying, let me know. I can try to dial back in. And usually that gets rid of it, but if it's not a problem, I'm going to go ahead and get going then. I told you on Tuesday I was going to try to spend most of the time in today's class on some stocks. You know, it's been a while since we've been able to talk about a lot of stocks as we've been in this bearish trend. And now I need to point out, though, that doesn't mean that I'm suggesting you run out and start buying everything and loading up your trading account. As you're going to see in the portfolio today, unless I see something really weird in the markets during my class, sometimes you'll get some big reversal that will change my mind or something like that. I'm going to add a few things, but I'm going to be just small. We're just going to nibble a little bit. We're doing it because the market is kind of breaking out of that downtrend line. And so you have to respect that maybe the market is turning a little bit more bullish. However, I'm going to show you something that I was looking at last night. Student in the class emailed me, Dave, you know who you are, and gave me or had a chart of an overlay between what the market looks like the last year, basically, and what it looked like back in after the internet bubble of 2000 to the 2002 low. And I usually don't put a lot of I don't usually put a lot of emphasis in those types of correlations you can find in the markets all the time, and they don't necessarily predict what's going to happen next. But I think that what was interesting is that I've been talking about, the market still declining and still not showing that, having that panic sell-off. You've heard me say that over and over. And actually what happened back then illustrated almost perfectly what could happen, and why I keep saying we've got to be careful. Although the conditions are different, we weren't in an inflationary environment or anything like that back then, and there's different things, there's different reasons for the moves that take place, and that's why you don't want to put too much of an emphasis on the past. Every segment in time has its own unique features, but human nature is what doesn't change, and that's why the charts are pretty amazing, and why patterns repeat themselves. Is that although the reasons for moves can be different, the human nature aspect of it is usually pretty much the same. So I'm going to get to that here in a second. There's not much to talk about on the direction alerts. Again, we're kind of in the middle, inching a little bit towards the right side now but we're not in any extreme range. So we could, if the market does want to rally right here, it could. If it wants to sell off, it could. We're not stretched either way. The sentiment, though, is getting really extreme, as you can see here. It just keeps inching higher and higher. This is extreme right here, and this is how far we've gone since turning extreme into that extreme sentiment. That means that the market is just not afraid at all, which is very often when you get some of the biggest declines is when the market's too complacent. Now, it's a different type of complacency. It's more of it does have an element of bearishness in the market. So I'm not suggesting that nobody thinks the market can drop. It's just that they're less worried about it, basically, as we kind of come along here, and especially as we're starting to kind of break out a little bit. But that is something to kind of keep an eye on and be aware of. All right, let's go. I'm going to go right over into the chart here. And and this is, and let me go to the 2-year chart here. So what we've been focused on is this downtrend line. I'm not going to draw a perfect line here, but you can kind of see that downtrend line. And every time we've sold off on this sell-off right down here, the VIX didn't get above 40. 40 is just a basic level of what I call panic selling. 30 is fearful selling, but 40 and above, and usually it's well above, 40 to 45 to 50 in that range is panic selling. Never, the VIX did not spike above 40 here. It did not spike above 40 here. Did not spike above 40 here. Did not spike above 40 here. We had this move in December. We thought that was going to lead to another move lower. It held. It started to move up, and as it moved up, and now we talked about Tuesday how we were breaking out of that downtrend line. That's significant, something to watch. It's the first time it's done it. I know this line isn't perfect, but it's the first time it's broke that downtrend line since the market started selling off last January. This puts in a higher low right here, and the next area we're looking for is this high right here. See if we punch above that. Now we have a higher high. Okay. So I went back and looked at that move down in 2002. Now I'm going to use my other charting service so that I don't, because it also, to pull that much data into TradersPro to go back that far, it takes a lot of time to load that up. I already got it all set up on my other charting service. So this is what it looked like from the internet bubble collapse 2000 down to the market low in 2002. And now we don't have as perfect a trend line here where it touched perfectly, like we did this last year. It didn't touch perfectly on that line here or here. I connected it to this was the highest point to connect to, so I connected that line through there. So it's not again, we're not dealing with exactly the same formation here, but notice the choppiness of the move down. I went back and looked at the VIX. The VIX didn't spike above 40 on this move, did not spike this move or this move, did not spike above 40 on this drop. It did spike above 40 here, but this move right here, this last part of the move was 9/11. This gap down was 9/11. So you can understand there'd be panic selling after an attack in New York like we saw, like we've never seen before. And even then, it didn't last very long. It just that actually kind of marked a near-term bottom right there. But so I would say that was an anomaly right there. It was hovering around here, and it wasn't near 30 before that event happened. And like I said, it rallied right after. So it was a little bit of I'm going to call that a little bit of an anomaly. Here's where it broke the trend line right here. And in doing so, actually, hold on, let me pull that up. Let me zoom in a little bit here. So here's where it broke the trend line initially right here. And it didn't last very long. It came back below that trend line. And this is, and I don't know, that was just barely a break. So, it could, that's why I don't get too caught up with exactness. It still kind of hovered around that trend line. This is a better break above it. We had a couple of days. This I think was back in March of 2002, if I'm not mistaken. Yeah, March of 2002 had a pretty solid breakout of that trend line right there. What that also established was this is a little bit of a higher low at that point, and this was the previous lower high right here. We rallied up to there, and another thing that's interesting too is I went back and checked. Went back and Googled stock market headlines on that day, this day where we broke out of that downtrend line. Notice how we were also breaking above the 50-day moving average, which is something that traders look at a lot. A lot of and algorithmic traders and things like that factor in. And there's a lot of these headline news that we're saying, are we finally turning the corner? We've had this big decline from the internet bubble. Are things finally turning the corner here? And it looks like things are starting to improve and get better. And there's a whole bunch of people that were turning more bullish. And there's all these kind of little things that very similar to what we're hearing today. The worst is behind us. This was probably the bottom back here. A lot of people were calling that the bottom, and especially because of it involved an event like 9/11, and what happened is that we did rally pretty strong here, decent volume coming in, couldn't take out this high right here, stalled a little bit, and then we started to decline. Now this decline isn't that big of a deal. It's just kind of work. You could still make the argument that it was kind of in a corrective mode. Maybe this is an ABC and it's going to go higher. But it rolled over finally, and on this drop right here, that bottomed in July of 2002. It was actually one of these moves a couple days before was the VIX spiking above 40. In fact, it got up to about 45 or 50 somewhere. I think it was in the high 40s or mid 40s or something like that, if I can remember. So the reason why I'm pointing this out again, I want to be real careful here because, it's really easy to look at this kind of correlation here and say, the same thing's going to happen, or it looks exactly the same, so the same thing's going to happen. That's not the point of doing this. The reason why I'm doing this is, number one, it's kind of freaky that it's so similar to what we're dealing with right now. But it kind of illustrates why I keep being cautious about, charging forward and believing the bottom is in. I keep saying we never had a major market correction without a panic sell-off. And could this be the first time it happens? Yeah, but that's what these people back here were thinking, that maybe this could be the first time it happens, and maybe the worst is behind us. And they got the panic sell-off. Now, also keep in mind too that they got the panic sell-off and it didn't go straight back up. A lot of congestion back in here as it bottomed out for almost a year. It bottomed out. It took to kind of complete that bottoming process before then going on a tear, leading into the financial collapse of 2008. And then 2008, obviously, we got a panic sell-off in 2008. But it's also pretty similar to, because a lot of people have been talking about this, trying to note some of the similarities between the internet bubble and what we dealt with during the internet bubble. You had these companies that were .coms that were coming out left and right. Back in 2020, after COVID, we had all this money was being pushed into the market to keep the market from crashing, or keep the economy from crashing. A lot of these SPACs and startup companies, and that was very similar. A lot of that speculation that people were throwing money into these companies and these companies are still, some of them are still around, but they're not. They never made any money. They're just burning through cash, trying to survive, most likely going to go bankrupt, and very similar type conditions. And we had to kind of work through that. This is not a bad kind of model to look at, as to, just to kind of see how long it can take for markets to work through those party periods of time. That's the thing. Whenever the Fed, or whenever the Fed starts flooding the market with money, you're going to pay the price at some point. And it's not free. Those stimulus checks are going to end up being the most expensive thing that ever happened in your life. Whatever amount they sent out, a few thousand or whatever, is probably going to have a $10,000 or $20,000 effect on your life, whether it's in all the higher prices you paid for years, on the house payments or credit card payments that you're having to pay, 5 times as much. It'll end up being the worst thing that end up happening to you. And yet everyone looked at it as free money, and they're still talking about do we do another round of stimulus to prevent to offset the effects of inflation on these poor working families? There's a better way to help poor working families, and it's not giving them another stimulus check. I can tell you that, if you know anything about economics. All right, so anyway, I thought that was interesting. Thanks, Dave, for starting me on that little get my mind kind of working a little bit on that. And we'll see how things kind of play out. Like I said, we can go right back to this chart here. So again, now we had a few more dips in the process through here, and like I said, and we really hugged this trend line perfectly until we're breaking this. By the way, this was the break. It did gap up above it, but by the end of the day, it was back below it. That was that CPI report that came out in December. We're breaking out a little bit right here, putting in possibly a higher low. Again, I said keep an eye on this, see if it can break out above there and go to a higher high. I think it is worth noting, though, that everybody's been seeing has been watching this area, this breakout. This downtrend line is not something that I created or that I'm the only one seeing it. Now, if you've only been listening to me, then I've been your only source to see it. But anyone that knows how to read a chart has been watching this and been looking at this and aware of this. But what's interesting is that, if you look at the behavior from when we broke out on Monday, we kind of paused a little bit. That was waiting for the Microsoft earnings. At first, the Microsoft earnings were viewed as negative. Market gap down at the open, rallied, but look where it closed yesterday. It just closed right in that same area there. Now today we're up a little bit. We broke up a little bit, but look at the candle. It's an indecision candle. It hasn't gone anywhere. You'd think that, man, everyone's been waiting for that breakout. Why isn't the market just taken off? Now it might be getting ready to, and that's why we're going to go ahead and get into a few positions in case it does. But we want to see how it behaves at the next level we're going to look at is this level right here. Can it break out above there? What happens if we run up into there and then we get a big, strong bearish reversal candle? We'll see what happens at that point. See if it does lead to another move down, and it could just kind of bounce around a little bit. Some of the talk is that a lot of people were expecting the bigger sell-off to happen in the first part of this year. It didn't, and so that if we start working our way up a little bit, or it could turn more people more bullish, thinking the bottom is in. We're hearing that a lot. People saying that, the bottom's in. Mark my words, October was the bottom. They got to get their calls out there so that if they are right, they can take credit for it. If they're wrong, you'll never hear from them again. They'll give you, well, this happened and that changed everything. But the point is that it could turn the market crowd a little bit more bullish, or think that the worst is behind it, and that's when you can sometimes get that panic sell-off, is when people are least expecting it. So we're still going to continue to be cautious, but we do need to do something with this breakout. We can't just think that we know what's going to happen in the future. We've got to kind of trade what price is actually doing. Price is breaking out, so we need to follow that. All right. Okay. Dave, I was going to give you credit because your emails what stimulated my mind to look at it, and so you got to get some credit for that. I'm not going to take all the credit. And it could be that we're a bunch of idiots if it doesn't play out like that at all. But at least it's entertaining, if anything, to kind of see that correlation and see if it possibly ends up playing out the same way. All right, I don't want to go through all the other charts. Again, the same similar patterns. I want to get to stocks here, but I did want to point out bond market we're still watching. Again, can it break out above here? This is the range we're looking for. It's kind of moving a little bit sideways right here, which would indicate that it's probably more likely to break out above there. We'll see. We'll keep an eye on that. Gold continues to just kind of keep going higher. And we're continuing to stay in our gold trade. Oil's been, what happened, we talked about how it broke out a little bit right here, broke out of that. Now since then it's been moving a little more sideways, but again, when you have an impulsive move up and it's moving sideways, it's a bullish formation. Oil is looking like it wants to go up, at least in the near term. Now we've noted how whipsaw it's been over the last several months, but oil is still the top sector, and there's some stocks within there that look pretty good, and companies that, as long as the price of oil stays up in these levels, they're going to make a killing. They're set up to make a lot of money, and those trends could continue to go higher, even if oil kind of flattens out or moves sideways. There's individual oil stocks that are really looking good, and we're gonna add a couple to the portfolio. By the way, that's where we made most of our money in the bear market over the last year was with oil and energy stocks. That sector's been at the top of the list for a while. The dollar continues to act like it wants to go lower. It's been a little bit sideways lately, but it could rally up a little bit, but this looks corrective. Previous move was down. We're expecting that it'll continue to move down until it changes, until it shows us something different. We're going to assume that trend is going to continue to move lower. The VIX, this is, again, it continues to be my reason to, I got my chart all messed up here. Here we go. Continues to be my reason to feel it's going to be hard for the market to rally. We're now down below 19 today. We got down to 18 at this low last Friday. Do we get below 18? If they're getting below 18, it's like, okay, man, this is an area where you're more likely to see volatility pick up when it's at these extreme levels. They're more likely to go up and continue to go down when you're at these levels, and that obviously means market going down. So we'll see how that kind of plays out. Chip stocks continue to do well, although we got a little bit of an indecision candle today. But we talked about that correlation on Tuesday, so I'm not going to go through that one. Transports, Bitcoin's kind of consolidating a little bit. That I talked about that on Tuesday. Is potentially crypto could be bottoming or starting that bottoming process. And by the way, bottoming process, it could be that you've had this rally and then you come back down and retest the lows again, or even sometimes you go a little bit lower. When you get the panic sell-off, this is definitely a panic area. You have all the bottoming type feelings of what happened with crypto during this area right here. Nobody wants to own it. Corruption taking place, bankruptcies taking place, things like that. That doesn't always mean it's the bottom. That's why we can never pick exact bottoms or tops, but it's acting like that. And so could it come back down and retest the lows? Yeah. Could it go even a little bit lower? We've seen that before with bottoming process taking place. Could it just have a little pullback and then break out higher? Sure. I mean, it could just start taking off. But this is also, I think this is important to point out, because this is what has to happen this is why the Fed wants to crash the economy. And I know that's a pretty blunt way to say it, but they need, in order to battle inflation, they got to crash the economy, or at least slow it down dramatically. You got to change behavior. You can't have people running out there and going and buying it right away. They got to be scared to spend or buy. And that's what's happened now with Bitcoin. Is you had the euphoria up here, and that wasn't even the top, but you had these high levels there where people, you remember, I never participated in crypto, but I had friends that did, and they were always bragging about it, how much money they made, and there's this one and this one and this one, and it was just, anytime they'd pull back a little bit, they'd buy more, and it was just a no-brainer. They were just that way. They were just conditioned to do that. Well, you can't have a pullback for 2 months and then go right back up again, because that behavior hasn't changed. They haven't been damaged enough to where they're like afraid to get in. What's happened with Bitcoin is we've got slammed so much, and there's so much time that's gone by with this decline that it's created this area of, man, I don't want, maybe you dodged maybe you were in the FTX debacle, and you're like, I'll never go back into crypto again. Or maybe you dodged it, but you're like, well, maybe is my currency crypto exchange going to be next, or what are they doing? Or I've talked to the same people that were the crypto bulls, and some of them are still holding theirs, but they're not buying more, and they almost kind of just joke about it as, well, I've got it, it's not worth very much, and I'm just praying it'll go back up some point, but I'm definitely not buying anymore. And so that behavior is completely changed, and that's what I'm trying to teach you, is that there's a psychological element to how the market moves. And I'm not saying you base your whole trade decision on that. I don't, but you can use it in conjunction with the charts to tell you where you're at within these cycles. And again, what's been bothering me is it just doesn't feel like a bottom yet. And I've been through enough major bottoms now to know what that feels like. And some of you that are just starting out, what I'm hoping for is that you get that experience through this, that we do finally get that panic sell off to where you can say, okay, now I know what that feels like, and what Jerry was talking about. Maybe you went through it with crypto, so you have a little bit of a understanding of what it's like. But it becomes a foundation now for you going forward in how you analyze your charts. You have that experience that you can't just, I can talk about things all the time, but until you experience stuff, it becomes ingrained in you, and you've got, and for the rest of your trading career, you can rely on some of those things to guide you through some of the unknowns that take place in the market over time. All right. Let's get into some trades here. So again, we're kind of mildly bullish. Want to just kind of get into a few things. If we go straight to the new buy list, this is a real easy way to find trades that could be ready to go right now. They already have the buy signal. The buy signal was triggered yesterday. Because what happens is overnight, the whole database updates, and because again, you can't know if the buy signal is going to be a buy signal until you have a closing price. Because I've seen stocks that have a buy signal during the day because they're right on the edge, and then right at the end of the day they fade and they go back to a hold. So it can't update it. It's not going to update it in the middle of the day. It's going to wait till after it's closed. So these are all based on new buys from yesterday's. Yesterday's candle was went to a buy signal. And what you're looking for is there a pattern on the chart? Do I like the trend? Do I like the pattern? Now, let me go to kind of a blank screen here, a little bit of a blank screen. So let me just show you kind of the basic patterns that I love to look for. Obviously, is it stair stepping up? Is it in a nice clear uptrend? It looks like it's stair stepping up. You get these impulsive moves, corrective, impulsive, corrective. It looks like you're following trend lines. It's following a plane. I love those types of moves. Now, the problem with some of these is that you could be getting in near the end of the trend. When you can see the trend, a lot of times you could be getting near the end of the trend. You always have to keep that in mind. But these are great for shorter term trades where, okay, I'm not going to maybe ride this for the next year or two, but if it looks like it could rally for 2 or 3 weeks, and I'm going to just capture this last part of the trend, these are great patterns to do that. If I'm looking for a longer term type position, what I'd like to see is a big drop that's come down, and then kind of a bowl shaped bottoming move where it looks like a rounded bottom like this. And then what I really like is when it starts really taking off on this right side, and then you get a corrective move of some sort. And I call this moving up the right side of the bowl. So you have the decline, and it looks like you're moving up the right side of the bowl. You know, a lot of times you're on this move up, you're breaking above the lower highs, you're breaking above those. So you're going to some higher highs through here, and then you get this little corrective move that tells you that the pullback here is not aggressive selling. It's probably just profit taking, or just lack of, a little bit of a pause in the buying. You had this initial pause or initial buying and then pause a little bit. I like those type of patterns. I like another variation of that is when it comes down, and then you get what we call an inverse head and shoulders pattern, where it looks like an upside down head and shoulders. These are the shoulders, this is the head. And then it starts breaking to higher, these were lower highs and lower lows. It starts breaking to higher highs and higher lows. I like to see that type of formation as well. Now, these ones, usually you're closer to a bottom. Remember, we can't know exactly where the bottom is, but these offer pretty good reward to risk trade situations. If you're wrong, you usually don't lose very much. If you're right, these sometimes have the potential to make these huge moves. With these bearish inverse head and shoulders patterns, you can take the distance from the neckline to the base of the head and project that distance upward. You see me do that. It doesn't always go that exact distance, but a lot of times it does. And so these types of patterns give me a lot of confidence. They don't always work, and that's why we still have to manage our trade, manage our risk. But they work enough times, and they have worked enough times over the years where you have confidence that there's a good chance they'll work. And that confidence in your trade is important. The expectation that it should go to a certain area or should make a certain move. Now, don't let that confidence get too strong to where you ignore your management, meaning if it doesn't work out, you don't want to be saying, oh, well, it's an inverse head and shoulders pattern, and you stay in the trade, because I've seen a lot of these they look like an inverse head and shoulders pattern, and then now you're down to here. And nope, that was just a correction within the downtrend. It can end up being something else. And so you've got to be able to stop out. You can't just, you stay in the trade, overstay the trade. All right. So let's take a look at our new buy list. And like I said, this is a quick and easy way to find something that might be ready right now. This one at the top, I usually don't like to go below a 90 strength rank. Now, there are situations where I might do that. Some sectors, you just don't get high strength ranks in certain sectors. You'll get to know that as you go through these and analyze these sectors. And I'll talk more about those when we're in more of a bull market condition and we're analyzing a lot of different sectors. I'll say a little bit, like construction, for instance. A lot of the construction stocks, you don't get a lot of 90 strength rank construction stocks. That's just been my experience. And so I try to use it in a little bit of a relative sense. I'll say, okay, well, I'll dip down into the 80s then, and I'm willing to go a little bit further into down in the strength rank. especially if the pattern looks really good. All right, so I like this one at the top, this HLX. And again, this is one of those that I was showing you where you see a clear uptrend, and you've got your trend line right through here. Impulsive, corrective, impulsive, corrective, impulsive. Looks like it's maybe in the correction. Now this could be wave A, wave B, wave C, and then it could go higher. But it's really outperforming, and it's in the oil sector. So oil has been moving. That one pattern looks pretty good. And just be aware though that it's possible that could just be wave A, wave B, wave C, and then takes off. So you might want to give it a little bit of a wider stop if you're considering that. Maybe have it below this breakout area right here. You can probably get it below the breakout, below this corrective move right here. Give a little room. Now on the trades I'm going to get into today, I'm not going to give much room in the stop. I'm going to have a pretty tight stop because I'm worried that because if we're going to take off, we're going to take off right here. If we don't, then we could still have that ugly downside move still, and so I don't want to be risking too much and get hurt too bad. Because the whole point of what I've been doing over the last year is trying to preserve capital. We've done a few trades. We've used those inverse ETFs when the market has dropped to try to make a little money. But the number one goal is we're trying not to lose money, so that we can get the full effects of market bottoming out and going into a new bull market. We don't want to get this far, be this patient for this long, and then get hammered. And so we're going to be a little bit cautious here. But what we're trying to do is stick with, as best we can, stick with the top sectors. And for now, all right. So another one in that say that a lot of these there's a few of these. I've got about 5 of these in the new buy list. Another oil stock, Exxon Mobil. Now, Exxon Mobil was part of that glitch that happened on Monday. And I'm going to be really ticked off about this for a while because it messes up all the charts. A lot of those trades were canceled. So they're really and even if they weren't canceled, it's not considered a true move. It was a glitch. But it affects this candle looks like it opened all the way down here and then came all the way back here. That's a huge move. It didn't happen. So you have to kind of ignore that day, and we're going to have to ignore that day for a while. And we're going to have to, I remember when the flash crash happened, same thing. It wasn't a real move, but it had these wild candles that were there that were bothering me for the next year. It got less and less as you get further away from it, and I do tend to focus more on the last few weeks on a lot of my charts. But it's going to be you just have to be aware if you see a real unusual candle on any of your stocks. It didn't happen on all of the stocks out there; it was only on a handful. McDonald's was one of them, and there's a bunch of them that happened where it happened. But you'll just have to make a mental note of that. You got to ignore that candle. So if we ignore that candle, then you've got this nice little, it's been working its way higher, and today it's breaking out, and we call this a kind of a wedge or triangle type of formation here. Looks like we're breaking out of that. You can take the base of the triangle, project that upward as a target, but that's a strong move on Exxon, and now it's getting a little overbought, but so it could start to consolidate or pull back a little bit. Probably more likely just kind of move a little bit sideways. But if you're willing to hold it through a consolidation process or something like that, you could go ahead and consider that. hold on just a second here. What caused the glitch? They don't know, and they never seem to know. People throw out their little clues, but with all the what's going on nowadays is there aren't really any market makers anymore. What's kind of taken over the market making process is all these algorithmic computer trading systems. It's made the liquidity a lot better. The bid-ask spreads have come in really close and things like that. But a market maker, their job was always that if you've got to buy when someone wants to sell to you, and you've got to sell when someone wants to buy from you. Now you can move the prices to deal with the demand, supply demand. If so many people are wanting to sell, you could lower that bid price down because you don't necessarily want to buy. There's a lot of people buying. You don't want to buy too much, so the market makers would move the price down, and that's what caused the market to go down, or caused the stock to go down. But there was always someone there. That's why they're called market makers. They're there to make a market. You always knew you could buy when you wanted to buy and sell when you wanted to sell. Well, we don't have many market makers out there anymore. In fact, I'm wondering if there's even any around anymore, or if they even exist anymore, which means that, if someone's going to sell, there's no one to sell to. The price you can get these weird drops. Now, they don't happen very often, and I don't know if that's the cause of it or not. I've heard that as one potential reason for it. They never did really figure out exactly what caused a flash crash either. The sad thing is that it always seems to hurt the retail trader. They always cancel the trades on the big institutional traders so they don't lose their millions off of that glitch. But then they don't cancel it on the average trader that he didn't lose very much, but it might have been half his savings or something like that. Or, it's one of those things you have to accept. It could happen. That's why you don't want to have a lot of orders. Because imagine all those people that had buy orders or sell orders, had a stop loss. Guess what happened? They have actual. That's why I don't put actual stop loss orders out there too. By the way, is they got stopped out down here, and then within minutes it was back up here. They got killed. And some of those orders might have been canceled, but a lot of times, especially if they're stop orders, they don't cancel them because that's the risk of placing an actual stop order, is that you could get something like that happening. And so the brokers, anyway, they don't happen very often, thank goodness, but there's a lot of conspiracy theories out there about, is it truly an accident, or is it, I don't like getting into that stuff because I'm not a big conspiracy person, but it just sucks when it happens. Let's just leave it at that. And it sucks for the charts, trying to read the charts after it as well. All right, let's go into, let's find another one here. I like this CT, where is it? CTVA, Corteva, 91 strength rank. Now, what I like, I guess I could switch on the signals here. What I like about this one, this is in the agricultural sector, which has been hit a little bit recently, but you can have a nice little overall uptrend. This is looking at the 1 year chart. So over the last years, the market's been trending down. A lot of commodities have been trending up, and this is commodity related with agriculture. So it held this low, higher low here. We moved up, but what I really like is the pattern behavior right here, because you've got big sharp move down, impulsive up. So you have impulsive down, impulsive up. You see me talk about this all the time. Again, these are general characteristics, but these general characteristics, you need to learn these because the charts don't always play out exactly this way, but they play out this way most of the time, or a good chunk of the time, where again it gives you that confidence that you're reading this right. Again, you're not always going to be right on it, but it gives you an edge if you know how to read the trend behavior. Stocks tend to alternate between impulsive and corrective moves, impulsive down, corrective, impulsive down, corrective. When you get a trend reversal, not always, sometimes you'll get the rounded bottoms, but a lot of times you'll get impulsive down followed by impulsive up. And then you see the alternation switch again. Now what you look for, and this is what I've been looking for in a lot of these charts lately, is a lot of these stocks that rallied strongly off of a low, these beaten down stocks. What you want to wait for is, you don't want to chase that move. What you want to wait for is the next correction. How does that look? Because if it then consolidates here for a few days or weeks, probably not too many weeks, you don't want it to last too long, it's telling you that could be in a trend reversal. That's exactly what we want to see after an impulsive move up off of a low. Is not for it to come right back down again, but for it to hold it, move it a little bit sideways, consolidate it a little bit. And that's what we're seeing kind of happen right here. Now, that's not a huge move, so, we can't have a lot of confidence that it's going to hold that low and go higher. But, you could put your stop down below there and say, I'm willing to risk this amount. It has potential to get back up to this previous high, or again, in the case of that uptrend line, it could go up even higher than that. So the reward to risk looks good too. Question here, is the low in January the C? No. Oh, wait, unless are you talking about this right here? Let me go back to a longer term chart. Yeah, you could call this ABC. The problem with that though is you have two things that in hindsight, we could be looking back and saying, yeah, this was wave A, wave B, wave C. This was wave A, wave B, wave C. But the problem with calling this an ABC right now is that there's two things that make it unlikely to be an ABC, and that is wave C is supposed to be about the same length as wave A. This is like 3 times or at least 2 times the length of wave A, which it shouldn't be that long. This is probably stretching it as an ABC. And then the retracement. This one would be more likely, even though it has a little bit longer wave C, it's still about a 50% retracement of that move up. This would be a very deep retracement of that move up. So you have a deep retracement and a long wave C. See, at some point you gotta. This, I talk about this a lot, where you have these guidelines that you follow. You can always stretch things in the markets. You can always go back and look at a time when a wave C was 3 times the size of wave A, and it was an ABC pattern. That's the only thing you could make of it. But if you focus too much on possible moves, you're going to get into trouble. You want to stick to probable moves. And that's why I try to be as disciplined as I can with my ABC patterns in that I don't want wave C to be too much longer than wave A. It can be a little bit longer than wave A, so there's a little bit of allowance there. And I don't want the retracement to be more than that 618 retracement, or 61.8%. 50% is the main guideline there. I don't want to go past that if I can avoid it. Now, you could say, well, then does that give you less confidence in this trend working out? Well, what I'm really basing this on is the larger trend is still there. Okay. It could be that this is a start of a move down, and this is wave A, wave B, wave C of a bearish ABC pattern. And then it breaks down. But I talk about this in the Elliott Wave recordings. If you go on the YouTube channel and review they might even be in the education tab too. Review the Elliott Wave. There's a concept of trading wave 3 and wave C in there. this could either be a wave 3 or a wave C. And that's what I'd like to look for. I'll leave it at that for now because I want to make sure we get into all these other stocks. And but yeah, hopefully that answers your question a little bit. Yeah, it might. It maybe it's that low is just a larger wave A, and we're in a larger correction. It could end up being a larger correction. Yeah, that's. But I mean, there's a lot of things along the way there, especially just going back. So you could go back and just say, okay, I don't know exactly what it'll do for sure, but okay, let's assume this is I like the impulsive down, impulsive up corrected. There looks like a high probability this could be a wave 3 or wave C. At least go back up to these highs, put my stop down below here. If it came down, it would drop below this low and that trend line. That's where I know I'm wrong. And then maybe this does end up being a larger ADC and then takes off again or whatever. But there I've managed my risk. I'm risking this amount for it to go up above here and higher. That's all you can really do. No matter how much analysis you do, and this is something I have to keep reminding myself, when I start stretching my analysis, when I'm overanalyzing stuff, I have to remind myself, no, I can't know exactly what the stock is going to do. No amount of analysis is going to tell me exactly what the stock is going to do. And then the danger is when you try to add too much in your analysis, you get that paralysis of analysis. Well, this says it should go up, and this says it should go down, and this says it should go sideways. What the hell do I do? Whenever you feel like you're getting into that mode, start simplifying it. Get back to the stair step. Get back to the impulsive corrective, basic trend analysis, the fundamentals, and usually you'll clear a lot of that up a little bit. And then get back to your trade management. Say, okay, I can't know exactly what stocks are going to do. So what I can control is how much I'm risking on it, how I'm, where I'm getting in, where I'm stopping out, where I'm moving my trailing stop or whatever. Those are things that you can control, and that's what you start focusing on. All right. We haven't even gotten out of the new buys. So I got to speed this up. There's this Legend Biotech LEGN 91 strength rank. Again, throw out that day right there. Again, what I like is there's a congestion through here, impulsive move that broke out, and then this pullback is a little bit more kind of choppy back through here. That's not a bad pattern there. And then there's one last one here, T-Mobile, 91 strength rank. And this kind of has that little bit of that cup with handle type formation. By the way, that kind of falls into the bull move as well. You get a decline, and then it starts to move up the right side of the bull. And then when it gets back up to the breakout area, it'll consolidate a little bit. It gives you it looks like a cup with a handle. And usually the rule of thumb on those is that when it breaks out, it has a tendency to go up about the same distance as the top of the bowl, the bottom of the bowl, projected upward. Now, these don't always form perfectly, but you got a little bit of a bull move here, a little bit of a pullback here. And, if you want a tight trade management, you can just put a stop down below there. If you want to give a little bit more room, you could put a stop down below there. All right, let's get into so what I like to do a lot of times when I'm looking at adding trades to portfolios, I like to go to the sector tab up here, and I want to see, okay, what are the top sectors? It doesn't mean I always pick a trade at the top, because if I can't find a pattern, what I'll do is I'll start it here. If I don't find trades I like in here, I'll move down. And sometimes I don't find anything I like. These are at the top of the list, but it doesn't mean that the some of the stocks in there aren't looking great. Maybe they're starting to roll over. If they're rolling over, it's not going to show up in here for a while. It's not going to move these sectors down immediately. And so I'll start working my way down. Sometimes you can have stocks or sectors that are low right down here, but they're starting to move up. We're noticing a few of the computer technology stocks are starting to show some bullish trends, So this might be working its way back up to the top of the list. But these are the stocks, these are the sectors that have been outperforming. And so again, the part of the reason for the stock is you want to try to look for the strongest sectors and then the best stocks within those sectors and try to stick to that kind of approach. Just from a probability standpoint, it'll usually keep you in the not only the strongest sectors but the strongest stocks within those sectors. So under energy, now I like to go under the hold section because I usually like to look for stocks that are going from hold to buy, wait for them to go from hold to buy, although a lot of these have turned to buy signals today. But I like this First Solar right here. I think I might have mentioned this one on Tuesday, if I'm not mistaken. But 97 strength ranked, went to a buy signal today. Now this one, again, you look at the longer term trend. I like the longer term trend on this as well. Some of the oil sectors, coal, and some of the subsectors within energy have gotten beat up a little bit lately, but this is a nice strong uptrend, been doing very well. Now, could it be that this is wave A, wave B, and it has a wave C before taking off? Sure, that could be a possibility. But what I'm going to do is I'm going to have a pretty tight stop here. I'm going to use this area right here as my stop. And so I'm going to put my stop in just below that, about 162. Knowing that it could have a wave C, but if it has a wave C, it could mean the market is dropping. I just don't want to risk very much right now. Bottom line, like I said, I've worked this whole year we've grinded some profits this whole last year in the portfolio, but they've been small gains. But we've managed to still make money in the bear market, but mostly we've been able to protect. And so I don't want to get too crazy here and just give it back. So I'm going to put my stop right there. If it takes off and goes up from here, great. If not, I'm willing to take that risk and get stopped out. So let me go ahead and add this one. Add to portfolio. I'm going to add it to my stock specific class portfolio. As the current price right here, my stop price is going to be at 160. What did I say? 162. Now, you need to have that stop price in order to calculate some of these other things that I'm looking at. Now, I'm going to throw. I usually like to try to have about anywhere between 7 to 10,000 in each trade. Not that I'm risking that amount, but the amount that I'm buying, the amount of shares that I'm buying. And so I'll usually just say, well, what's 100 shares going to be? 100 shares is going to be 17,000. Okay, that's too much. 50 shares is right in that area. 8,000. That's probably about right where I want to be as far as allocation. Again, that's not what I'm risking though, and now I need to analyze the risk part of it. I usually don't like to have more than 1.5% of my portfolio at risk. This, if I get stopped out, this would be only 0.5%. So it fits that criteria. Now you might also take a peek at the dollar amount. Because I would lose $641 if I get stopped out at that price. Obviously, it could be worse than that. It could gap down or sell off before I stop out. But that gives me a general idea of what I'm willing to risk. That amount might be too high for some of you. Maybe you're like, I would really freak out if I lost $641 on a trade like this. Okay, then you've got to force yourself to buy less shares. Then get that. Maybe you only buy 25 shares to get that down to a $300 level. accepting the risk is an important part of this whole process. And you've got to focus on that because, every trade you get into, you think is going to work out, or you wouldn't ever get into it. You're never going to get into a trade that you know is not going to work out, right? But that's the problem. That's why people don't stick to their stop loss. Like, I calculated, but I didn't think it was going to happen. Do the opposite. Act like this trade isn't going to work out, and I could lose $641. How does that make you feel? That would really suck. It would really stress me out. Okay, lower that. What are you comfortable with? 200? Okay, maybe you're buying 20 shares or something like that. All right, let's go ahead and purchase. I got to really hurry here. Sorry. Another oil stock I want to get into is Schlumberger. So I have a alternative energy stock and First Solar, and then I'm going to get into the oil services. Where is it? Here it is. 93 strength rank. And again, I like the nice little steady uptrend here. Broke out. It's pulled back to kind of that breakout area. Moved up, corrected, moved up, corrected. Now maybe it only has one more move up. That's all right. I'm not overly bullish on anything right now. Now it is still at a hold signal. So you could wait for it to go to a buy signal, that extra confirmation. A lot of times what I'll do is I'll see it in a normal class when we're in a bull market condition. I'll see something like this and we'll put it in a watch list. And then I'll set up an alert. It'll email me when this goes from hold to buy. I'm not going to do that today just because we've been waiting to get into some of these, and it could be well past a buy by next Tuesday's class, and then we're not going to chase it at that point. So I'm going to go ahead and, for the sake of the class presentation, I'm going to go ahead and get in. I'm going to have a tight stop just down below here. It's going to be below this resistance here and this little support here. That's not a lot. Any little bit of a move down could stop me out, but I don't want to risk a lot right now. So I'm going to put my stop in at 53. And let's see what 100 shares would be. 100 shares would be only 5,000, so we could go a little bit higher than that. Let's see, 120. 30, 40, 140 is about right. I'd lose 523 if I'm wrong. My percentage portfolio at risk is less than 1.5%. Let's go ahead and purchase that. And then I did pick one off of the basic materials. So this is the next sector down. I liked FMC Corp right here, 83 strength rank, so it's down a little bit, but this is one of those sectors where historically you do get into the 80s. You only have two stocks that are in the 90 strength rank. They just don't get high strength ranks a lot of times. I don't know why that is, but you got a little bit of a kind of a bull and then a corrected. So you had this impulsive move up. This looks corrective. You could even say this looks like an ABC, and then this is an impulsive move up, and this is corrective right here, and it's taking off again. I'm not going to have very much risk, and my risk is going to be below here, which is like right at 125. I think I said my stop's going to be like 125. It's possible we can, if we market sells off, we come back into class next week and we're stopped out of everything. That's fine. At least I wouldn't have been risking very much. Stop price at 125. 100 shares would be too much. That's 13,000. Let's try 75. That's still too much for what I want to do. Let's 60. 60 is about right. About 8,000, close to 8,000. Very little at risk. 355 at risk. I'll go ahead and purchase that. All right, that's all I'm going to do. And I got to wrap things up. So hopefully that helps a little bit. We were at least able to do a little bit the stock specific class for once. Have a great weekend. We'll see you here Tuesday for the next market update class. Bye, everyone.